Hello, welcome to the weekly technical analysis review here at xm.com. I'm Rafi Boyadjian, currency analyst, and today is Monday, January the 16th, 2017. Today we will look at the major commodity pairs, the Aussie dollar, the Kiwi dollar, and the dollar loonie. So let's start with the Australian dollar versus the US dollar. Aussie dollar has retraced about 50% of the downtrend from the November 8 high of 0.7777 to the December 23 low 0.7159. The 50% Fibonacci level of this down leg is currently acting as immediate support at 0.7468, while the 200-day moving average is capping further gains. The near-term bias is bullish with the RSI comfortably above 50, though the positive momentum has eased slightly from Friday when the indicator came close to reaching oversold levels. Should the pair maintain its current uptrend, the next resistance will likely come from the 61.8% Fibonacci level at 0.7540. If, however, the positive momentum continues to weaken, the 38.2% Fibonacci level at 0.7395 should be watched to the downside, as this is also near the 50-day moving average. A break below this level would shift the near-term bias to negative and bring into scope the 23.6% Fibonacci level at just above the 0.73 level. Looking at the medium-term picture, the recent gains have not yet been enough to alter the slightly bearish structure that's taken shape since the death cross of the 50-day moving average below the 200-day one in December. Next up, we have the New Zealand dollar versus the US dollar, which is looking fairly similar to the Aussie dollar pair. The Kiwi dollar has retreated from the near 5-week high of 0.7147 set earlier today, but the near-term bias remains bullish, with the stochastics holding around oversold levels. The pair is currently just above the 200-day moving average, which should provide immediate support at 0.7085. Below that, the 38.2% Fibonacci level of the November to December down leg comes into view at 0.7067 as the next support level. A drop below the 38.2% Fibonacci level could accelerate any declines towards the 50-day moving average, currently at 0.7050. A breach of the 50-day moving average would risk shifting the near-term bias to negative. On the upside, the 50% Fibonacci level at 0.7130 has been acting as resistance during the past 3 trading days. A clear break above this level is therefore needed to sustain the current 2.5-week uptrend. The next resistance to watch above that is the 61.8% Fibonacci level at 0.7195. Lastly, today we will look at the US dollar versus the Canadian dollar. Dollar loonie has been on a downtrend since the end of December, and the slide has taken the pair below the Ichimoku cloud in the process. Prices recently found support from the 200-day moving average, which is currently at 1.31. The negative near-term bias is further reinforced by the MACD, which is in bearish territory below zero and still falling. If prices once again breach the 200-day moving average, the next support will come from last week's near 3-month low 1.3029. On the upside, the pair might find resistance at the Tenkan Sen line at around the 1.3240. While further up, the bottom of the Ichimoku cloud should provide resistance at just below the 1.33 level. A break into the cloud and above the 50-day moving average is needed to sustain the weak positive outlook in the medium term, which is in danger of turning neutral following the recent losses. That's it for this week's analysis. Thank you for watching and have a great day.